Good morning, guys, and welcome to the podcast. I have a fantastic guest for the audience today, the listeners and viewers, Ken LaCroix from Southern California. And he's a fractional CFO, and he helps business owners turn financial data into strategic growth. Today's topic is going to be all about turning data into profits. And we're going to hear about AI, his views and take. And I'm really happy to have him on. Ken, welcome.
Thank you. Thanks for having me on.
Yeah. And briefly introduce yourself, chronicle your journey, and we'll dive into the questions.
Sure. So, about 15 years ago, I hopped out here in Southern California as a fractional CFO and have been doing variations of that over time. Our sort of current iteration of fractional CFO is focused on really fractional FP&A, financial planning and analysis. We really try really hard to focus on that end of things and helping business owners and their management team understand the accounting numbers, understand the numbers that are part of their other parts of their business, their operating systems, tying them all together and seeing if we can't help them look forward and make better decisions with data rather than just the traditional looking backwards with financial statements.
Yeah, interesting. And what I really, we're a business entrepreneurship podcast. And so for the listeners and viewers that are interested, what is your client avatar? What is their pain point, frustration, or what are their aspiration or goals when coming to work with you?
In general, our clients are more stage of business than type of business. So they've usually hit about 5 million in sales. We have clients at 1 million and 2 million in sales that are getting ready to be at 5 million. But usually when businesses hit in general about that $5 million milepost, they start to outstrip their sort of traditional ways of understanding how their business. It's usually not financial statements. It's usually walking the shop floor, reviewing sales calls, making the sales calls themselves, looking at their cash balance, and so when they hit 5 million, all of a sudden they might have a different channel they're selling to. So if they were in distribution, they might have 5 customers and now they start selling direct to consumers as a separate channel. And now they've got thousands of customers. So it's a little harder to stay on top of things that way. They might have multiple warehouses, so they can't really walk the warehouse to see what inventory looks like. And really, as they grow, they're using working capital. And so their bank balances are usually strained. That's the question. I have sales, but why don't I have cash? Because again, growing businesses, especially if you sell on credit, use cash as they grow. And our clients are really at that $5 million to $50 million space where as they hit these different milestones, call it 5 million, 10 million, 25 million, 50 million, they need to institute more infrastructure in their reporting so that they can more understand the signal that's sitting in all the noise that they might be having in all their systems.
Yeah. And that's a great introduction. And what are some of the most common financial blind spots business owners overlook, and how can they start addressing them today?
I think there's some general frustration that happens with business owners when they review financials. I think if they go to their peer groups, they hear that they need to really understand your financials. And if they talk to their accountant or their CPA, they might they might get things explained to them, but there's a lot of jargon in our space. And in reality, the balance sheet, for instance, doesn't behave like most business owners run their business. And so I think it's important to understand that the financial statements are there for others to understand your business, investors, bankers, other people, and understand how your industry fits with other industries. So we set those aside and we use what much more common to use management accounting or cost accounting, if you will, where we're creating schedules that have a lot of granular detail, but they're only relevant for inside the organization. They wouldn't make much sense to those outside. And so I think it's recognizing that they might have this intuition that they don't quite think that the financial statements are right, but they keep being told that they need to understand their financials. And so that frustration is what we help them with. And we add additional information around the financial statements so they become a little more relevant. And I mentioned it before. I think for a growing business, not understanding your working capital, not understanding how increased sales will impact your cash and other things is a crucial mistake that often gets made until it's too late. In other words, I'm out of cash. What do I do now?
Yeah. And how do you help executives, business owners transition from gut instinct to data driven decisions? And how do you incorporate AI into all of this?
So step one is to get more granular data and more current data. So we deal with a lot of accounting departments, a lot of bookkeepers, a lot of office managers, a lot of controllers, a lot of folks that are managing the accounting. And historically, if we wanted something that was more granular, in other words, more amount of detail in accounting, or we wanted it faster, we had to pay more money. You had to add more resources or more bodies. Over the last 10 years, and specifically over the last 2 or 3, there's been tremendous amounts of technology that have come into the accounting space that allows us to take digital information, because now all information is digital, and keep it in that digital format rather than take an invoice that we received through the mail or through fax even. I still see faxes, or even through email, and then they print it or look at it and enter it into the system. We need those things to go in automatically. So now the accounting department is reviewing things, not doing things. And that's a very important distinction. And so once we have that data that's more granular, in other words, if there's an invoice that has 23 line items on it, we don't input the bottom line one number. We input all lines of that, all 23 lines, because if it's digital, it costs the same amount to input 23 lines as it does to input one line. So now we have more data that we can look at, and we have it more currently. We work hard to close the books in a few days, not a few weeks or a few months. And so now we have current information that we're dealing with, and it's accurate information. And so now we can start to do trending. We'll look back for 36 months, 48 months, 60 months, get a real feel for what's happening in the business. And from there, we can start finding out what are the drivers of profit and the drivers of sales and the drivers of efficiency.
Yeah, interesting. The other question is a lot of business owners, they track the vanity numbers, and you talk about these metrics don't matter and you help them focus on the metrics that matter and start driving profit.
Yes. So everyone likes to talk about sales, but what's really important is gross profit and gross margin. So we define gross profit dollars as the revenue you bring in minus the cost of providing that revenue, and the gross margin or the gross profit percentage as the percentage of gross profit you have, gross profit dollars, compared to your revenue dollars. And we watch those very closely. In essence, the result of that gross profit dollars is what you have left over to pay your more fixed expenses, your general and administration expenses. So we like to look at what your break-even point is, what your safety margin is, how much extra gross profit are you generating to cover your fixed expenses? And that helps us understand how much we can afford to invest, how much sales can go up. It's relatively easy to increase sales by lowering prices, and that'll come through with margins. So sales to us is a vanity number. Gross profit dollars and gross margin percent, that really reflects how well you're doing. And if you're able to raise sales and keep your margins or increase your margins, that's the sort of leverage that we're looking for.
And how can business owners find hidden profits in their financials even if they think they've already optimized for costs?
This is our passion. We feel strongly that, again, because historically it's been difficult to keep detailed and granular information, that accounting is a series of averages. And so your gross profit margin and your gross profit dollars are averages. And what we find is that there are sets of customer and item data that behave a certain way, that have a certain margin associated with them. And there are others, customer and item data, not just customers and not just items. Customer profitability is one thing, item profitability is one thing. But when we tie customers and items together, and potentially even customers, items, and vendors, if you purchase items from different vendors, or if you're a service organization, you have different people working on the same types of jobs, or a construction industry where different crews do different job codes. So we tie those all together. We find that they sit in a couple different quadrants. There are usually customers and items that are wildly profitable, 100%, 200%, 300% gross margin. There's a vast majority that are plus 5 or 10% or minus 5 or 10%. That they sit around the normal distribution. And then there are a handful of things that you're losing maybe 25, 30, or 40% on. And by looking, and again, it's not just customers, it's customers and items together, customers, items, and vendors together, customers, items, and teams, crews, people together. We find that by stratifying it that way, you work through the average. All that activity might average out to a 12% net income number, 12% net margin number. But if we can find the things that we're losing money on and do less of those or fix those, if we can find the things that are wildly profitable and do more of those, and if we can find the things that are hanging out plus or minus 10% and marginally get those all above 5%, we can make a dramatic impact on the profitability of the company. And it's not about firing customers or firing vendors. It's about having conversations with them to say, Here's what's happening on our side, what's happening on your side.
Interesting. I'm curious how you see, because in terms of these industries such as healthcare, how can you see a value add for you in the healthcare industry and any impending changes?
Healthcare has some real challenges. Accounting, first of all, doesn't support the traditional healthcare market with third-party payers. There's no third dimension to accounting that allows an activity to happen between a patient and a provider, but have a third party pay. And especially when that third party pay has varying levels of realization, varying levels of discounts, varying levels of reimbursement. And so we often find that for very good reasons, the bill side of things, the medical billing side of things, the healthcare billing side of things is different than the accounting system. So the big challenge is tying those two together and understanding what those dynamics are. Again, traditionally, the details that sit in the medical billing system were somewhat expensive to keep track of, but now with everything digital, all the information's there. So we focus on the medical billing side of things. That's where we're leaving the financials and going into more the operating system. And then we create ways of recording what those expectations are on the balance sheet. I think it's really important to estimate what you think your realization is and then measure against your realization every month or every week in some cases so that you can stratify again the different payers, the different reimbursement rates, and understand really where you should be moving there. That healthcare example is a good example of averages. Most traditionally, I should say, traditionally there was a realization number that was an average for the month, and that's what was recorded on the financials and reported. But if we can get upstream into that granular data, we can now start to stratify our payers and stratify our reimbursements that way and understand where our profits are leaking or where our profits are increasing and what we might do about that.
Interesting. How should CFOs be looking at AI to either automate, delegate, eliminate, or even enhance their business growth? How are you thinking about AI?
Embrace, get comfortable with it, start playing with it. It's available everywhere. The different LLMs are all over. Just start to get comfortable with it. And the best way to think about AI is really work on your prompting, really think about that prompt engineering. How are you tailoring your question? I have a favorite quote from Einstein that says, I'll summarize it. If I have 60 minutes to work on a problem, I'll spend 55 minutes defining the problem and 5 minutes solving it. And so I think of that as the AI corollary is if you have an hour, spend 55 minutes on your prompt engineering, 55 minutes on thinking, how do I really want to ask this question? How do I want to frame the question? What do I really want to know of all the information and data that's out there? And then spend 5 minutes reading the results, having ChatGPT or some other language of your choice spit that out. And so I think what's most important to think about, and that's counter to how we think about the world these days. The Google's just a couple of clicks away, and then we get lots of data. We kind of work through it and find our way through it. So that's number one. Number two, try and collect all the data you possibly can and put it in one central location. Historically, you've had data warehouses that have been somewhat constricting. You had to, in essence, define how you were going to use the data before you could store the data. But now there's plenty of tools from Microsoft, from others that just let you place all the information and it's all in its original format, all in its original schema. You don't have to worry about making it all the same schema. You don't have to make it fit into SQL. Just start collecting as much data as you possibly can and try and find as much history as you possibly can because AI thrives on more data. Humans get overwhelmed with more data. AI thrives on more data. And then try and implement it in your daily life. Try and spend a few minutes doing three things. Number one, subscribe to podcasts, newsletters, this type of thing, so you understand what's happening because the world is changing so quickly in the AI world. Number one. Number two, make it part of your daily routine so that muscle memory stays there. That muscle memory, you're always using AI and it always becomes your go-to. And then number three, make it a real big part of both your analysis and your month-end close.
And for people listening or viewing this, if they wanted to connect with you and reach out to you, how can they do that?
Our website is the best way, insightfulpartners.com. You can reach us there.
Yeah, excellent. Really fascinating conversation and really value add to the audience. And thanks so much for coming on.
Thanks for the opportunity.